Hi there, and welcome to another episode of The Generational Perspective. So this is a conversation between myself, John Thompson, a 32-year financial expert in the mortgage space, and my son, David, who's quick. What's your time in the business, Dave?
My time is just over 3 years in the mortgage world.
And the work we do really crosses pretty deeply into sort of financial stuff. Because of the nature of our business, how we do our business, we have a lot of conversations with our clients and our partners regarding finances and different ways of looking at things. We dig into financial planning and insurance and estates and trusts and lots of different things. But today our subject's going to be investing. Now, there's lots of different ways you can invest your money. We're going to sort of stay focused, at least on this episode, on the idea of investing in the equities market, which is more commonly known as just stocks, right? And those sorts of things, stocks and bonds and things that are publicly traded and out there kind of in the world. So, Dave, I'm just going to start by opening up. When did you sort of first realize that there was such a thing as investing and investing in stocks, if you even knew it at the time? Do you remember?
Don't know when I first realized it was a thing. I guess it's been so accessible to my generation growing up. I guarantee you I probably downloaded Robinhood freshman year of high school and had access to picking stocks or investing in stocks, and did so a little bit here and there at that time.
Yeah, that's an interesting way to start, because I look back to when I was your age. As of the time of this recording, you're what, 24? You're turning 25 in a couple of days. Yeah. Mm-hmm. Exciting. Congratulations. Anyway, so when I look back at that time, we couldn't get information. You couldn't get information quickly. I mean, if you wanted to buy a stock, you heard about things, you knew about things, but you had to call somebody, you had to call a broker, you had to open an account, you had to transfer money from your checking account to a different type of account, and then it might take a couple of days. If you wanted to get information on it, you generally had to go and look up something in a newspaper or a magazine. And even though the internet existed at that time, data wasn't readily available. So given that, do you think that the wide availability of all this information is helping investors or hurting investors? Do you have any opinion about that?
I think it helps spread awareness. I don't know that it helps maybe investing as a whole kind of unit, but for people individually. But I think it makes it more accessible to everybody and makes people aware of it. At least I certainly would not have picked up the phone in high school to call a stockbroker to invest in stock. So yeah, I guess it could get people in earlier, although it could lead to some trouble with that in itself and not being kind of educated around what you're actually doing.
I think one of the things that, and this is probably a broad generalization, but one of the things that people around my age, and probably more likely older than my age, would say is that, the younger generation, because of this easy access to everything, it's like a Vegas, right? They're not investors, they're just playing a game. Yeah. And you referenced Robinhood, and that's accessible to really anyone. I have Robinhood. Well, now they're not really around, but they are around, but it's been challenging to work with them at this point. But putting that aside, but what do you think of that commentary that people are like, well, you really don't know what you're doing. You're not an investor. You're literally playing a video game.
Yeah, I mean, that's a pretty common perspective for us. I know some of the people that I may follow or friends and peers may follow on social media. I think it's literally when you're investing or trading stocks and whatnot, if it's daily or whatever it might be, it's really just kind of, you're hitting the slot machine, and it could be the same as playing in Vegas. And I don't know that that's a valid perspective, but that's definitely a perspective out there for friends of mine, for sure.
Well, and I don't know if it's good or bad either. I mean, the idea of day trading has been around for a long time. I think through our clients, maybe you can think of just a couple that engage in sort of that activity. I don't know that I'd call them day traders. I think they're more focused on the marketplace and saying, okay, so I'm following these stocks and I'm looking for an opportunity to buy lower to add to my position type of thing. And that brings up the idea of sort of dollar cost averaging. I don't even know, Dave, do you understand what dollar cost averaging is? And could you explain it?
Yeah, sure. I mean, I know the concept. Explaining it's always fun. But yeah, just buying kind of on a consistent basis, regardless of if the price is up, down, sideways, whatever it might be. It's just consistent buying of the same thing over time. That way you're getting in the markets at different price points and whatnot.
Yeah, and I think just in an effort to sort of educate the people that might tune in, listen to this, is the idea of dollar cost averaging, as David explained, is the idea of if you're going to invest and you're investing for the long run, ideally, at least that's my opinion, is that if you find something you like, you buy it. Because the idea is that if you buy something at $100 and it goes down to $75, yeah, you feel bad, like, oh gosh, I lost $25. But if you buy at $75, now your average cost is $87.50. So now your overall cost is $87.50. And if it drops into $50 when you buy more of it, now your average cost has dropped back down again. So over time, the idea that if you're buying at all points in the marketplace, your average cost of something might be lower in the long run, as opposed to something that's going up all the time, even going in the same way. If it's $100 and it goes to $150, you're excited you went up $50. But now if you buy at $150, now your average cost is what? $125. Right. So you're actually, kind of ahead as well. So anyway, that's the idea of dollar cost averaging. Let's think about this idea of long-term. Do you feel like, as you're starting to invest, is this a long-term thing for you? How do you feel about investing? What's the purpose of it?
Yeah, of course, I think there's always a back of the mind. Oh, it's a rich, quick, hopefully, that thing. But no, my perspective is that it's for the long term. And that's why I'm not generally picking risky or just one single stock investments. It's kind of getting exposed to a group of things that have shown consistent appreciation over the long run. And as compounding takes its effect over long-term periods, that's kind of what my goal is. But yeah, there's still always that back of the mind of something's going to explode one day and I'll be rich quick.
I guess kind of on that note, how do you think about hiring people or a financial advisor? And so tell me a little bit about your experience with either doing a little bit on your own versus, the experience of working with someone to help you pick or manage a portfolio of investments.
Yeah, I think when you're working with somebody, it's a little more calming. There's just another perspective there for you to reassure you to kind of stick to your goals, because you're going to share your goals with them, hopefully. And they're there to kind of keep you in check, keep your goals on track. If the market dips a bit, they're there to manage that emotional time and make sure you don't sell, do something wrong. I would always say that they're probably there to make sure you don't make mistakes that can lead to bigger losses than you'd want to take. And when you're by yourself, I think you would maybe stick to a few investments that you find may be working. And then if there's some trouble in the markets and they don't work out, that's unfortunate. So I guess it's making sure you don't hit those weird mistakes that can come up.
So I'll sort of two quick comments that may be helpful. One is that there are a number of studies that show that investors that invest with advisors, and lots of different kinds of advisors, we'll talk about that in a different episode, but there's lots of different ways you can get advice, and advisors are going to help you in this world, and different fee structures and all that kind of stuff. But the bottom line in all of them is that by having someone on your team that's helping give you direction, those people tend to outperform the market, regardless of fees, the expense to invest, regardless, they outperform the market somewhere between 2 and 3%. And it depends on the study and so forth. So if on your own, you're averaging, let's say 7%, you might earn 8 or 9% by doing that. Or conversely, if you're down less than in other marketplaces. So that's one piece. The other piece of advice that I got, or that I read actually, from a guy named Rick Edelman, who's a well-known financial planner, one of the largest financial planning companies in the United States. He's put out a lot of books that I've read, and I think I've had you read some of them, David. Yeah. So Rick Edelman says, be more worried about the return of your principal than the return on your principal. In other words, if you're going to invest $150,000 in something, be more concerned about getting back your $150,000 than earning, doubling that money in a few months. Now, there are opportunities to make money in lots of different ways. So I'm not saying that people shouldn't do that. But the bottom line is when you're making a decision, think about, are you going to get your money back? So anyway, we can talk. Why don't you talk just quickly, Dave, about sort of the three ways, that all investments are kind of looked at, whether it's investments in gold or oil or stocks and bonds. We have these three kind of criteria. And if you're willing to trade one for the other, you get a different result on those. You know what I'm talking about?
Are you talking about safety, liquidity, and return?
Yes, I am. Go ahead. Why don't you just explain those quick concepts? Because I think they're really simple, and I think they lay the foundation for people to think about how to invest in whatever it might be.
Well, I'll start with return. Return, I think, is where most investors want to think about or spend their time, because that's, we want to make money on what we're investing. So we want to make sure we get a good return on our investments. And so the riskier things are, usually the higher the return might be. The less risky, the lower the return will probably be. Again, if we're talking conversely about safety, I guess it's kind of the opposite of that. If it's a safe investment, then maybe you're looking at a smaller return. If it's a not so safe investment, again, a higher return. And then liquidity is obviously if you have access to whatever that investment might be, how quickly you can get it back in cash, I'd say. So yeah, what would you like to touch on there?
No, that's right. I mean, safety, liquidity, rate of return are the key elements. And so if you told someone you can earn 10% on your money consistently, but you can't have it back for 3 years, is that a good thing or not a good thing? If you were told you can have this money available tomorrow, but we're really not going to pay you very much on it, is that important? Or you're told, here's an investment, it's about a 5% chance that you're going to ever get your money back. But you know what? If you do get it back, it's going to double. Is that a good thing? And that's, safety. So anyway, think about those things as you're out there investing and so forth. What would you say that you've learned? What have you learned from me, if anything, about investing?
Well, I've learned to seek out other people's opinions and advice. And that's probably step one, that as much as we want to think we can do everything ourselves, sometimes it's best to go out there and find somebody else to get another perspective on something or just help. And I've learned to be careful with my money. I know you've kind of ingrained that in our heads. We don't, at least from when we were younger, we don't, if we have the money, great, we could buy something. We don't usually ever want to spend more than what we're making or spend something, buy something that we don't have the money to pay for. So that was kind of always growing up. I had that principle. And so that's been important because I think that's allowed me not to outspend whatever I have or whatever I earn. And the same may not be true about many other people out there. I think that's a good starting point. And yeah, just kind of going on that, I think you've also taught us to take investment seriously and do them early. So learning about it early, reading about it, whatever it might be. I think those are some things I've learned from you.
Great. Well, thank you. There's a book that I almost always recommend to people as a beginning point to think about money and investing and how to use the money that you already have to grow more money. I don't know if you know the book I'm talking about, Dave.
I do. Yes.
You do. So what's that book?
Richest Man in Babylon.
Yeah, The Richest Man in Babylon. So it's a parable book. If you've not read it, you should read it. It's an easy book to understand, but like many things that are easy, they're difficult to implement. Like people, they don't follow the tenets in the book very easily, but it's a wonderful story. And I highly recommend that book. It's a great way to start. And there's lots of others, but I'll leave our audience with that recommendation. The Richest Man in Babylon. There's used copies all over the place for $1, but if you can find it for free, that's better than use that money for something else. Any questions, Dave, you have for me, or final thoughts you want to leave?
Sure. I guess one question would be, growing up or whatever, getting older, investing, how often should you be managing or checking your investments? And is it better to leave it alone? Is it better to check it constantly? What do you think?
It's a fine line, and I think it's different for every single person. I think it takes a rare person to put your money somewhere, trust the process, and assume that it's going to grow and be there. That being said, I certainly don't think you should be on your phone checking what's happening on a daily basis, maybe not even a weekly basis. It depends how active you are. If you are playing with individual stocks, you probably do need to be more active because you need to put things in there. And there's so many great tools now that you can put into the automated trading systems where I'll say, okay, if I'm buying a stock at $35, if it drops under 28, I want to sell automatically. If it goes up, those kind of automated tools are now there. So that's a little different. But I think generally speaking, money that you're saving for your future, your retirement accounts, your 401ks, your investment account for a house, or whatever the other thing might be, I don't think you need to look at them that often, maybe once a month. I quite honestly, in my situation, I sort of recap everything about every probably 3 to 6 months. I go back and just kind of see how things are doing, add up all my balances again, kind of recalculate my net worth and see where we're at. So maybe that doesn't answer your question, but I would divide it up into the categories. If it's long-term money, I don't think you need to look at it that often. You're going to get statements, so maybe not, maybe they're paperless now. But maybe you look at when your statement comes. But other than that, I don't think you need to spend a ton of time doing it. But I would, however, recommend that you review your goals and review what it is you're trying to accomplish at least once a year. And once you have someone else in your life, a spouse, a partner, whatever it might be, they've got to be involved in the conversation. I would also say, just from a family perspective, that as parents, Ina and I decided early on to try to include you guys in sort of the conversations as much as we could. I think that you've been at the table when we've met with financial planners. We've tried to include you in the ideas around trust planning and those kind of things as well. So if you're a parent out there listening to this, I think share those things with your children. You don't need every single detail, but the big picture is what you need to share. So they understand what's going on, because they're going to be part of it and they're going to learn from that. Did you learn from it, Dave?
Yes, absolutely. I've learned from it, of course.
Great. All right. Any final thoughts?
That's it.
Okay. So thank you. Be consistent, be persistent, enjoy your life, but any excess cash flow you got, invest it wisely, smartly, hire people to help you, get advisors, but be nimble, right? Be looking for opportunities and you'll do great. All right. Thanks very much.